All right, everyone, take a deep breath.
Yeah, you're going to need it today.
You really are. It's Friday afternoon, February 20th, 2026. The closing bell is just minutes away right now.
Almost there.
And if you are looking at your screens, if you're looking at the terminal right now, you are seeing an absolute sea of green.
It's blinding.
It really is. It looks like a massive party. It looks like the market has just been handed, the greatest gift in financial history. The NASDAQ is practically vertical.
Straight line up.
Exactly. And the retail sector's out there popping champagne. Transport stocks are catching a massive bid. It's euphoria.
It certainly looks that way on the surface.
Right.
But if you look a little closer, if you look the corners of the market that aren't flashing on the headline tickers on cable news right now, you start to see a very, very different picture.
And that is exactly why we are here. Welcome to the Deep Dive.
Glad to be here.
Today, we are activating what we call the Theta fuse. We have a massive stack of sources to get through today.
Oh, yeah. Court rulings, legal filings.
We've got analyst notes from Wedbush, stuff from UBS, real-time ticker data, and our mission for this deep dive is pretty simple.
We need to stop you from getting swept up in this crazy Friday euphoria.
Exactly. We want to help you see the trap that might be waiting for you when the market opens next week.
Because the headline is massive.
Yeah.
There is absolutely no downplaying it. The Supreme Court has made history today.
Historic.
But that headline is masking a structural crack in the financial system. And that crack widens significantly this afternoon while everyone was busy cheering.
So let's unpack this. Here is the roadmap for today's deep dive. First, we obviously have to talk about the headline itself.
Right.
The Supreme Court has struck down the Liberation Day tariffs. The market is cheering. But then we're going to pivot to the real story.
Which is really a three-part situation. One, the Supreme Court ruling isn't nearly as clean as you think it is. Two, the U.S. government essentially just lost its credit card, and the dollar is tanking right now because of a potential $170 billion refund nightmare.
Which is just a staggering number.
It is. And three, and honestly, this is the scary one. We have to talk about the canary in the coal mine.
We're talking about private credit. We are talking about a major financing failure that hit the wire today involving Blue Owl Capital and CoreWeave.
Yeah. This is the stuff that actually breaks markets.
Not the headlines. The plumbing.
Precisely. The tariff news is a macro shift, but the credit news, that's a liquidity event. And historically speaking, liquidity events win.
Every single time. So grab your coffee or, maybe something a little stronger given the week we have all had. Let's dive in.
Let's do it.
Okay, so let's start with the big one. The case is Learning Resources, Inc. v. Trump.
Right.
This has been the massive elephant in the room for almost a year now, really since last April.
April 2025, Liberation Day. That was the branding they went with.
The branding was Liberation Day, but the actual on-the-ground reality was tariffs ranging from 10 to 50% on virtually everyone.
Right. Friends, enemies, frenemies.
It totally didn't matter. If you sent goods to the U.S., you pay the tax. And today, the Supreme Court finally stepped in and said, stop.
And they said it emphatically. This was not a narrow ruling. It was a 6-3 decision. And for those of you who follow the court closely, the breakdown of that vote is absolutely fascinating.
Yeah, it wasn't your typical ideological split at all.
Not even close. You had the liberal wing justices, Sotomayor, Kagan, and Jackson, but they were joined by Chief Justice Roberts.
And wait for it.
Right. Justices Gorsuch and Barrett.
That is the key alliance right there.
It really is. You have the textualists, Gorsuch and Barrett, agreeing completely with the liberals.
Strange bedfellows.
Very. And what they essentially said was that the president does not have the statutory power to do this alone. The administration leaned on a law called IEEPA.
Right, the International Emergency Economic Powers Act, which sounds incredibly serious. International emergency.
Oh, it is serious. It was passed back in 1977. And ideally, it's used for very targeted things. Sanctioning terrorists, freezing the assets of rogue states.
Things like that.
Exactly. It was never intended to be used as a blunt instrument to rewrite the entire tax code of the United States on a whim.
Right.
And that is exactly what the court ruled today. Chief Justice Roberts wrote the majority opinion, and he was crystal clear.
What did he say?
He said, IEPA does not authorize the president to impose unilateral tariffs of, and this is the, quote, unlimited amount, duration, and scope.
Unlimited amount, duration, and scope. That is the kill shot right there.
It really is. They are basically saying to the executive branch, you went way too far. You overstepped. And naturally, the equity market absolutely loved this.
Oh, the market just went nuts. I mean, if you look at the board today, the Dow, the S&P, the NASDAQ, they all actually started the day kind of wobbly.
Yeah, there was some weird economic data early on.
Right. But the second the Supreme Court ruling hit the Bloomberg terminals, boom, instant reversal, face ripper rally.
And you have to look at who is leading the charge today to understand why.
It's the importers. It's the companies who've been getting absolutely crushed by these taxes for the last 10 months.
Apparel and luxury are flying.
Nike is up huge, Levi's, Under Armour. Abercrombie & Fitch is having an absolute field day right now.
Well, it makes perfect sense if you think about their business models. If you are Nike and suddenly a 20 or 30% tax on bringing your shoes into the country vanishes overnight.
Your margins just exploded.
Exactly. Your profitability outlook for the entire rest of 2026 just got a massive upgrade.
Stanley Black & Decker is another one popping on my screen. Industrial tools.
Right, because they rely heavily on global supply chains to source parts.
So the narrative right now, the one you were seeing blasted on CNBC and reading in all the analyst notes, is certainty. The market hates uncertainty, and the Supreme Court just removed a massive chunk of it.
We saw Dan Ives at Wedbush pushing that exact narrative. Extreme tech bullishness. UBS put out a note talking about resilient economic growth.
Right. They are all cheering.
They are. But it only removed some of the uncertainty. And this is exactly where we need to start peeling back the onion for you.
Yes.
Because the algorithmic trading and the headline readers are reacting to 3 words. Tariffs struck down. But, as is always the case with the Supreme Court, the devil is buried in the details.
And this is where it gets incredibly interesting for anyone actively managing a portfolio right now. Because while everyone is out there celebrating the death of the IEPA tariffs, there is another set of tariffs that are still very much alive and kicking.
That's right. And this distinction is critical for anyone holding tech stocks, especially going into next week.
So break it down for us.
The court struck down the use of IEEPA, but they did not touch Section 232.
Okay, help us out here. IEEPA versus Section 232.
Yeah.
To a normal person listening to this, a tariff is a tariff. It's a tax at the border. Why does the specific name of the law matter so much?
It matters entirely because of the legal justification behind it. IEPA is about economic emergencies. But Section 232 comes from a completely different law, the Trade Expansion Act of 1962. And that law allows the president to impose tariffs if imports threaten national security.
Oh, national security, that's the magic phrase.
It is the ultimate magic phrase in Washington. The Supreme Court has traditionally been much, much more hesitant to question the executive branch when they invoke national security grounds.
They give them a lot of deference.
A huge amount of deference. So while the Liberation Day tariffs, which were broad, sweeping, and purely economic, are gone.
But targeted tariffs on strategic industries remain.
Exactly. They are completely untouched by today's ruling.
So let's give everyone the list. What is actually still being taxed right now?
Well, the big one, the really big one for the market is semiconductors.
Oof. Okay. That's a problem.
Specifically, there is a 25% levy on certain imported chips. And if you read the actual source material from the trade representatives, it explicitly mentions Nvidia.
Nvidia, the one stock that basically holds up the entire S&P 500.
Yes. The Nvidia H200 chips, they're still subject to Section 232 tariffs. Those taxes did not go away today.
That is massive because Nvidia earnings are coming up next week.
Exactly. So if the market is aggressively buying Nvidia today, thinking, hey, free trade is back, costs are going down, they are completely mispricing the risk.
The cost of those chips hasn't changed a single cent.
Not 1 cent. The friction in that specific supply chain hasn't changed at all.
What else is still on the Section 232 list?
Copper. There is a 50% levy on semi-finished copper products. That stays.
50%.
Lumber and wood products. Those stay. Automobiles. Those stay.
So basically, if you are building a house or buying a car or, and this is the important one, building a data center that needs massive amounts of copper wiring and GPUs.
You are not seeing the same relief that the guy buying a pair of sneakers is seeing today.
Right.
And this is the fine print trap we're talking about. The market is rallying broadly right now. It's lifting all boats. But some of those boats specifically the ones tied to national security commodities and heavy tech infrastructure, are still firmly anchored by Section 232.
That is such a crucial distinction. It's kind of like the market heard that mom and dad are out of town, so they threw a massive house party. But they totally forgot that the strict uncle is still living in the basement watching the security camera.
That's a very colorful way to put it, but yes, essentially. And frankly, the algorithmic market's inability to distinguish between these two legal frameworks in the heat of the moment today, that is exactly where the opportunity and the danger lies for you next week.
Okay, so that is the tariff bomb segment. The Liberation Day IEPA tariffs are out. Section 232 is still very much in. But that brings us to the second part of our thesis for today, the money.
The money.
Because usually, historically speaking, when trade barriers come down, that's supposed to be good for the economy, right? The efficient markets, lower consumer costs. You generally expect the home currency to strengthen on that kind of pro-growth news.
Typically, yes. A pro-growth free trade move is almost always dollar bullish.
But today
is different. The Bloomberg Dollar Spot Index dropped 0.2%. It's actually down quite significantly for the day when you look at the intraday chart.
And Treasury yields, the interest rate the U.S. government has to pay to borrow money, those climbed.
Right. So the dollar is weaker and sovereign borrowing costs are higher. That smells like fear in the debt markets.
What exactly is the bond market so afraid of right now?
They are terrified of the U.S. government's balance sheet. You have to remember, for the last 10 months, the administration has been forcefully collecting these tariffs. They have brought in tens of billions of dollars.
And the government, being the government, has probably already spent it.
Or at the very least, they counted on it. They plugged that revenue right into the budget projections. It was a massive new revenue stream. And today, the Supreme Court just reached out and turned off the tap. Just like that.
So the incoming revenue stops immediately. That widens the federal deficit. And that explains the Treasury yields going up. The government now has to issue more bonds, borrow more money to fill that unexpected hole.
Correct. But it's actually much worse than that. It's not just that the revenue stops moving forward. It is about the money they already collected over the last 10 months.
Oh boy. The refunds.
The refunds. We are talking about an estimated $170 billion to $175 billion.
Oh, wait. $175 billion? That is not pocket change. That's,
right.
I mean, that's a new Navy fleet. That's a small country's entire GDP.
That is the amount estimated to have been collected by Customs and Border Protection under the IEPA authorities since April.
Unbelievable.
The Penn Wharton budget model economists put out a warning that this revenue is now severely at risk. Because now that the Supreme Court has said the underlying collection of that money was completely unlawful,
the companies want it back.
Oh, they want it back immediately. We are already seeing reports that over 1,500 companies have filed lawsuits in the U.S. Court of International Trade.
1,500?
Yes. They were just sitting there waiting for this exact ruling to drop. Now the floodgates are open.
But does the government actually have to pay it back? I mean, practically speaking, can't they just say, well, sovereign immunity are bad, but we already spent it?
That is the multi-billion-dollar question right now. And the Supreme Court, in its infinite wisdom, completely punted on that specific issue today.
Of course they did. Why make it easy?
The ruling today strictly struck down the future application of the tariffs, but it was completely silent on the remedy for the past collections. They did not issue a refund order. They explicitly left it to the lower courts to figure out the mess.
Which just means years of chaos.
Absolute chaos. Justice Kavanaugh, in his dissenting opinion, remember, he was one of the three who voted to keep the tariffs. He explicitly warned about this exact scenario.
What did he write?
He wrote, and I quote, "The process is likely to be a mess."
A mess. That's quite the technical legal term from a Supreme Court justice.
In this specific case, it really is the most accurate term. Think about the sheer logistics of this. You have importers who paid the tariff at the port. But lots of those importers immediately pass that cost on to you, the end consumer.
Right. Prices went up at the store.
So if the government refunds the importer directly, is that a windfall profit for the corporation? Do they get to keep the tax refund even though the consumer absorbed the pain?
Oh, wow. I didn't even think of that.
Does the importer have to somehow refund the consumer? How do you even prove who ultimately paid what across a global supply chain?
It sounds like an absolute lawyer's dream and a macroeconomist's nightmare.
And a currency trader's primary reason to sell the U.S. dollar today. Because if the U.S. Treasury is suddenly on the hook for a $175 billion lump sum payment, That is a massive fiscal shock.
Yeah.
It is an unbudgeted liability of historic proportions. That creates immediate doubt about the U.S. fiscal standing globally, hence the dollar drops.
And when the dollar drops and yields rise concurrently, that dramatically tightens broad financial conditions.
Exactly.
So even though the supposed tax cut of removing these tariffs is good for equities on paper, the stealth interest rate hike coming from the bond market is very bad for the underlying economy.
It's a massive tug of war. The equity market is staring at the tax cut. The bond market is staring at the debt crisis. And if you look at financial history, the bond market is usually the smarter one in the room.
Always. Okay, so we have the legal confusion with Section 232 remaining active.
Yeah.
We have the fiscal black hole with the CBP refunds. But now we really need to talk about the thing that actually made my stomach drop when I saw it flash on the tape today.
The canary in the coal mine.
Yes. We call this show the Theta fuse because we try to find the burning fuse that everyone else is ignoring while watching the fireworks. And today it's about private credit.
Right.
And it centers specifically on two names, Blue Owl Capital and CoreWeave.
I cannot stress this enough. This is the most critical part of our deep dive today. If you take absolutely nothing else away from this discussion, please listen to this.
Let's start with CoreWeave. For those who maybe don't know, they are the absolute darlings of the AI startup world right now.
You really are.
They aren't a traditional software tech company. They are a specialized cloud provider. They basically go out, buy thousands and thousands of Nvidia GPUs, string them together, and rent that massive computing power to other AI startups.
Right. They are the underlying infrastructure of the entire AI boom. They are the pipes.
Exactly. And today, on a Friday when the broader tech market is absolutely rallying on tariff news, CoreWeave stock is down roughly 11%.
It's trading right around $86.52 last I checked.
Why? I mean, logically, if broad tariffs are gone, CoreWeave should be thrilled. Buying chips just got cheaper, theoretically, if we ignore the Section 232 reality for a second. Why are they crashing while everything else is soaring?
Because of Blue Owl Capital. Blue Owl is an absolute giant in the world of private credit.
Let's quickly define private credit for the listener, just so we're all on the same page.
Sure. Traditionally, if a massive company needed, say, $1 billion to build a factory, they went to a syndicate of major banks like JP Morgan, or they issued corporate bonds to the public market.
Right.
But after the regional banking crisis a few years ago, traditional banks really pulled back, regulators cracked down, banks stopped lending heavily to risky, capital-intensive tech plays.
Enter private credit to fill the void.
Exactly. These are non-bank alternative lenders. Massive asset managers who take huge pools of money from pension funds, sovereign wealth funds, and ultra-wealthy individuals, and they lend it directly to these companies.
Bypassing the banks entirely.
Bypassing the public markets and the traditional banks. It is a booming multi-trillion-dollar shadow industry, and it has been the primary financial fuel for the AI fire.
Because AI requires so much upfront capital.
Right. When CoreWeave needed billions to build out new hyperscale data centers, private credit wrote the check. They used the Nvidia chips as collateral and just kept lending.
Until today.
Until today. The news broke this afternoon that Blue Owl was completely unable to arrange the financing for a $4 billion data center project for CoreWeave.
$4 billion.
Yeah.
And they just couldn't raise it.
They couldn't syndicate it. They couldn't close the deal. And honestly, the context makes it so much worse. Earlier this week, Blue Owl actually halted redemptions on one of their major funds.
Halted redemptions. I mean, that is arguably the scariest phrase in all of finance.
It really is.
That means institutional investors went to Blue Owl and said, hey, we want our cash back. And Blue Owl looked at them and said, no, you can't have it.
It signals a severe liquidity crunch behind the scenes. It means the money is stuck in illiquid assets. And if Blue Owl, which, remember, is one of the biggest, most respected blue chip names in this entire space,
right,
if they are freezing up and they physically cannot fund CoreWeave's expansion,
then the physical AI build-out hits a literal brick wall.
Precisely. This is not a demand problem. Everyone in the world still wants more AI compute power.
Oh, yeah.
This is a pure liquidity problem. You cannot build a $4 billion data center if the lender's bank account is frozen. And if CoreWeave can't build the data center, they don't buy the next batch of Nvidia chips.
And if they don't buy the chips?
Nvidia suddenly misses their forward earnings guidance. The entire AI trade, which has propped up the S&P 500 for years, begins to unravel.
That is the real contagion risk right there. The retail market is looking at the Supreme Court today and cheering for free trade, but the institutional credit market is looking at Blue Owl and seeing frozen capital.
It's the gears of the machine literally grinding to a halt. You know, we saw the phrase private credit jitters on the ticker tape earlier this week, but it just felt like background noise at the time.
Yeah, just typical market chatter.
But when you actively connect Blue Owl failing to fund CoreWeave specifically today amidst all this other chaotic macro noise, that feels like the definitive start of something much bigger.
It's the classic Hemingway quote, right? How did you go bankrupt? Two ways, gradually, then suddenly.
Exactly. Risk happens slowly and then all at once. We are arguably in the final stages of the slowly phase right now. That 11% stock drop in CoreWeave today, that is the warning shot across the bow.
So what does this all practically mean for you, the person listening to this right now?
Oh.
We have a market that is deeply confused. It is broadly euphoric about the tariff headlines, but it's completely ignoring the private credit crunch and the dollar devaluation happening under the surface.
What it means is massive volatility. It means the price action going into next week is going to be incredibly violent and unpredictable.
Which brings us to the core of what we do here, the Theta fuse strategy. We told you right at the top of the show that we are absolutely not chasing this green rally today.
No, absolutely not. Buying naked calls right now, essentially just betting that tech stocks will blindly keep going up, is incredibly dangerous.
Why?
Because the options premiums are ridiculously expensive right now since implied volatility is so high. And the risk of a sudden rug pull from the credit side of the market is massive. You could get wiped out on a Tuesday morning gap down.
But on the flip side, we also don't want to just sit entirely in cash and lose our purchasing power while the dollar continues to drop due to the refund mass.
Right. Doing nothing is also a losing trade right now. So we look at the Theta play, we look at systematically selling cash-secured puts.
Let's walk through the actual mechanics of this for the listeners. Why this specific strategy right now in this exact environment?
When you sell a put option, you are essentially acting as an insurance company. You are selling downside protection to someone else. Someone out there is terrified that the market is going to completely crash next week because of this Blue Owl contagion. So they are willing to pay a very high, juicy premium today to protect their portfolio.
So we step in and we take that premium. We collect the cash up front today.
We take the cash. And in exchange for that cash, we legally agree to buy a specific stock at a lower predetermined price if it falls by a certain date.
But, and this is the absolute golden rule of the Theta fuse, we only do this on companies with bulletproof balance sheets.
Bulletproof, no exceptions, no CoreWeave, no speculative, debt-heavy growth companies.
Right. We are looking for mature companies that are sitting on literal mountains of cash. Companies that do not need to borrow a single dime from Blue Owl or regional banks or anyone else to keep the lights on.
We're talking about the fortresses, companies like Apple, Microsoft, maybe even Berkshire Hathaway.
So the underlying logic here is, if the market actually crashes next week because of the private credit crunch, we get assigned the shares. We end up owning fundamentally great companies at a massive discount compared to today's euphoric prices.
Exactly. You put the stock at a lower strike price that you are already perfectly happy to pay anyway. You acquire a world-class asset on sale.
And what if the market just stays irrational? What if it just keeps rallying on this tariff news and completely ignores the credit risks for another month?
Then the put option we sold simply expires worthless. We never have to buy the stock, and we keep 100% of that rich premium we collected up front. We generate pure income.
It's a win-win scenario, provided you actually have the capital sitting there to buy the stock if assigned.
Right. Never sell a naked put. It must be cash secured. But conceptually, it's about being the casino, not the gambler.
Especially in a schizophrenic market like this one. When the mainstream headlines are screaming victory, but the underlying plumbing of the financial system is screaming blockage, you want to be positioned to passively benefit from the confusion.
You don't want to be victimized by the whipsaw.
Don't chase the rally with calls. Sell the fear with puts. I really like that framing. But again, to reiterate, only on extreme quality. If you sell puts on a highly leveraged company that suddenly goes bankrupt because they can't roll over their debt, you're in massive trouble.
That is what we call the kill zone. Any company that requires constant new debt issuance just to survive is firmly in the kill zone right now. Stay far, far away from them.
Okay, we're coming up on the end of the hour, and I really want to recap this effectively because we threw a massive amount of macro and micro data at you today.
Let's simplify the whole board.
Point one, the Supreme Court struck down the IEPA Liberation Day tariffs. It was a 6-3 vote. Roberts in the liberal wing, joined by Gorsuch and Barrett. The retail market absolutely loves it.
Point 2. Section 232 is still very much alive. Strategic goods like Nvidia AI chips, copper, lumber, they are still being taxed heavily at the border. Do not forget this detail when you are evaluating tech hardware stocks this weekend.
Point 3. The impending refund mess. The government potentially owes up to $175 billion to importers. Because of this fiscal shock, the U.S. dollar is dropping and Treasury yields are rising. The sovereign debt picture just got significantly uglier.
And point 4, the really big one. Private credit is actively cracking. Blue Owl halted redemptions and critically failed to fund CoreWeave's $4 billion data center. The AI infrastructure build-out is currently facing a severe liquidity shock.
You put all of that together, and you have the perfect recipe for a massive, headline-driven fake-out rally today, followed by a brutal credit reality check next week.
That is unequivocally my base case. The legal victory at the Supreme Court is great for broad market sentiment, sure. But at the end of the day, liquidity is what drives asset prices, and liquidity is visibly drying up.
So here is the final thought we want you to take into the weekend. And it's a bit of a provocative one.
Go for it.
We have spent the last entire year absolutely obsessed with the executive branch, wondering what the president will do next with tariffs, what the next tweet will be. And today, the judicial branch finally stepped in and loudly said no.
Right.
But next week, I think we're all going to find out that the most powerful branch of government isn't the White House, and it certainly isn't the Supreme Court.
No, it's the bond market.
It's the bond market, and it's the risk committees sitting at these private alternative lenders. They are the ones who actually decide if the lights stay on at the hyperscale data centers.
They hold the real purse strings. The Supreme Court gave corporate America a massive tax cut today, but Blue Owl literally just cut up their corporate credit card. Which force do you think wins out next week?
I have a sinking feeling we're all going to find out bright and early on Monday morning.
I think we will. It's going to be a fascinating open.
Keep your eyes completely glued to the credit spreads, people. Don't just sit there blindly watching the green arrows on the equity screen.
Watch the yield on the 10-year Treasury.
Watch the news out of Blue Owl and the shadow banking sector. That is where the real story is actually unfolding.
And try to have a great weekend. Seriously, try to disconnect from the screens if you can.
If you can manage it. Thanks for taking this deep dive with us. We will see you on the other side of the weekend.
Take care, everyone.
Okay, wait, hold on. Before we actually cut the recording, I literally just saw one more alert flash on the terminal regarding the mess that Justice Kavanaugh talked about.
Oh, really?
Yeah, because we didn't really touch on the actual timeline of this refund nightmare.
Oh, for the CBP refunds.
Yeah. I'm looking at this analyst note from the Penn Wharton economists again. They are saying the revenue is, quote, at risk. But realistically, practically speaking, how long does this kind of massive trade litigation actually take to resolve?
Years.
Like multiple years.
Absolute years. Remember, the Supreme Court didn't explicitly say cut the checks today. They essentially punted it back down to the Court of International Trade. So now, each of those 1,500 different companies has to individually prove exactly how much they paid. Then, the government lawyers are going to step in and aggressively argue, well, hold on. You sold those sneakers or those tools to the end customer at a 20% markup anyway, so your corporation didn't actually lose any money. The American consumer absorbed the loss.
The pass-through defense.
Exactly. It's a classic legal maneuver.
Yeah.
The government is going to argue that refunding the corporations directly would constitute unjust enrichment.
Unjust enrichment.
Right. They will literally stand in court and say, you collected the tax from the retail buyer, you remitted it to us, and now you want us to hand it back to your corporate treasury. So you basically get paid twice for the same pair of shoes.
Mathematically, that actually makes complete sense in a very twisted bureaucratic way.
It is an incredibly strong legal argument. And what it means practically is that while the massive liability of $175 billion sits menacingly on the government's balance sheet, scaring the daylights out of the bond market today, the actual cash might not physically leave the Treasury for a decade.
Wow. So we basically get the absolute worst of both worlds.
Pretty much.
The bond market panics about the ballooning debt today, driving up borrowing costs for everyone. But the affected companies don't actually get the stimulus cash to reinvest in their businesses for years.
That is structurally the most likely outcome. It is a massive lose-lose scenario for the short to medium-term economy.
Unbelievable. And that perfectly explains why the dollar is reacting the exact way it is right now. It is algorithmically pricing in a decade of legal uncertainty.
And as we always say, uncertainty is the absolute killer of currency valuations.
Which, ironically, brings us all the way back to CoreWeave again. Looking at this intraday chart one more time.
Yeah.
$86.52. Still down roughly 11% on a massive green day. If this specific $4 billion deal with Blue Owl definitively fell through, is there literally anyone else out there with the balance sheet to step in on short notice?
That is the core of the problem right now. The traditional Tier 1 banks are heavily regulated. They have strict Basel III capital requirements.
Right.
They cannot just blindly step in and underwrite a $4 billion unsecured loan to a cloud startup with CoreWeave's specific risk profile overnight. It's legally impossible for them. The entire reason private credit got so massive in the first place is precisely because the big banks were handcuffed by regulators.
So if private credit is suddenly tapped out or spooked into freezing?
Then there is an immediate vacuum. A massive capital vacuum in the tech sector, and financial nature absolutely abhors a vacuum. Usually the only thing that fills it is a violent crash. Asset prices simply have to come down to a lower, more attractive level where institutions are actually willing to take the lending risk again.
So you were saying CoreWeave at $86 is absolutely not a buy-the-dip opportunity yet?
I wouldn't touch it with a 10-foot pole right now, not until we explicitly know if they have a viable plan B for funding that specific data center.
Because if they don't?
If they are forced to significantly delay the physical build-out, their forward growth projections are completely toast. And if their forward growth projections are toast, their current valuation, which is entirely based on the premise of exponential, uninterrupted AI adoption, just collapses.
And if CoreWeave collapses?
Well, we've said it a million times. They are arguably the single biggest marginal buyer of Nvidia GPUs on the planet right now.
It's just a giant house of cards.
Yeah.
A very high-tech, incredibly expensive house of cards.
Supported entirely by a massive, unseen foundation of private shadow debt that literally just got very, very shaky this afternoon.
Man, this Friday suddenly feels incredibly heavy.
Historic market days usually are when you actually read the pape. But honestly, that is exactly why we do this deep dive, to filter out the noise and find the actual signal.
The signal today is Theta. Don't gamble. Sell the premium. Stick to bulletproof balance sheets. Stay safe out there.
And for the last time, keep watching those credit spreads.
Right. Okay, now we are actually officially signing off. Thanks for sticking around for the extra analysis, everyone.
Goodbye and good luck next week.